Will a gold standard ever make a comeback? That is the topic we are discussing today with Michael Klein. He is a professor of international economic affairs at the Fletcher School at Tufts University. He's also an executive editor and founder of EconoFact. Welcome to the show, Professor.
Thank you, Danielle. It's nice to be on.
So I invited you on today because your essay fell on my lap, an essay that has caused quite an uproar in the precious metals community. It's entitled, "What's the Gold Standard and Why Does the U.S. Benefit from a Dollar That Isn't Tied to the Value of a Glittery Hunk of Metal?" And to give context, the talk of a gold standard was revived thanks to President Trump's nomination of Judy Shelton to the Fed Board of Governors. That nomination has since taken a step back. But nonetheless, she still has a chance at the Board of Governors, and she is known for advocating for a return to some sort of a gold standard. So my first question to you, Professor, is, why the essay? Why now? Did it have to do with Judy Shelton, or is there more to it?
No, sure. It had to do with Judy Shelton because that brought up yet again the issue of whether or not the United States should move to a gold standard. So in the absence of that nomination, I would not have felt the need to have written that essay. But given that this topic rose again, I felt it was incumbent upon me to talk about it.
So let's go a little bit more in depth on your essay here. Before we begin, do you have any feelings about gold as an investment before you penned this essay?
I have absolutely no feelings about gold as an investment. I would note, though, that its price is very volatile. And as a boring academic, I don't like that kind of volatility. At the beginning of the year, the price of gold was about $1,500 a troy ounce, and then it went up to over $2,000 at the beginning of August, and now it's back to about $1,800. So I like to sleep at night, so I don't want my investments to be that volatile.
So you must really hate Bitcoin then.
Another thing I avoid. Yes.
Right. Yeah. Okay. So let's talk about your essay. So you're saying we should never go back to a gold standard. Why?
Well, a gold standard is a fixed exchange rate system that ties the hands of a central bank, and it ties its hands in a very specific way to the price of gold. Now, there are countries, of course, that are on fixed exchange rate systems. For example, the Euro area is a completely fixed exchange rate system for all members. But the European Central Bank has latitude on how to set monetary policy and interest rates for the countries in the ECB. But if you're on the gold standard, the goal of the central bank is to peg the price of gold. And the volatility that I was just talking about suggests that there'd be a lot of volatility in monetary policy as well.
So I want to take a quote from the essay. You said, while central banks today typically cut interest rates to boost a faltering economy, the gold standard required them to focus solely on keeping their currency pegged to gold. That's true. So under a gold standard, a central bank, like what we're seeing today, wouldn't be able to just keep printing money, correct?
That's right. But it would be forced. Well, sometimes it would have to print money, and sometimes it would have to contract the money supply, depending upon what's happening to the price of gold. But that means that it's changing the monetary policy with response to the price of gold, not with response to the economic conditions in the country. So, for example, in 2008, when the economy was cratering, it was very important that the Federal Reserve be able to increase the money supply and try to act nimbly to save the economy from the disaster that could have happened. And likewise, this spring, with a similar kind of problem, it was very important that the Federal Reserve and central banks in other countries as well could step in. The idea behind the gold standard is one where the stability that the gold standard is supposed to provide would lead to price stability. And so the last time there was really much talk about the gold standard was in the late 1970s, when inflation was very high. So it's a little bit curious to talk about the gold standard now when the main reason for having a gold standard is to tame inflation. But if anything, inflation has been too low. For example, the Federal Reserve has a target of 2% inflation. That's not a ceiling, it's a target. But it's only achieved that target in something like 4 out of the last 40 quarters.
So you do not think, Professor, we're in an inflationary environment right now?
Sure doesn't look that way. If you look at what the inflation rate has been over the last 10 years, it's been quite low. And as I said, it's been below the 2% target. You know, Daniela, people have been predicting hyperinflation in the United States ever since 2008, 2009, but it just hasn't materialized. And in a way, it's been a bit of a puzzle for economists. Why hasn't inflation been higher? But the fact is, it hasn't been.
Like, I've said this in past interviews. I felt the difference recently, even just, grocery shopping or going to the pharmacy. And, I think the reality for many Americans, they would argue that no, inflation is already here. So it's interesting to hear you to say that.
Well, it's important to make a distinction between the prices of some goods and services that change and the overall price level. So a gold standard policy is aimed not at the price of milk or eggs or oranges or baby diapers, but the overall price level. And the overall price level shows no evidence of very high inflation.
Going back to the quote that I mentioned where you were saying that it keeps the currency pegged to gold. Can't governments under a gold standard always devalue their currency in gold terms?
Yeah, but then why have the gold standard if you're going to break it all the time? So it doesn't really make sense to say, well, we're going to have this standard, but sometimes not, sometimes we will. So, that seems to defeat the whole purpose.
The greatest, I guess, counter argument to your essay is that, the gold bugs are saying, look, the governments don't want a gold standard again because gold is the most serious and ultimate threat to government power.
Yeah, I don't really understand that, because what that's saying is that governments only raise money through what's called seigniorage, through printing money. But governments also sell bonds. We see a very big debt in the United States. The debt to GDP ratio is now over 100%. Governments raise money through taxes. So it's not like the only way that governments can raise funds to spend is through the printing of money. That's just a misreading of government finances.
The other argument that came up is that, you speak of how this, we're now in a free market society, but they're saying, what free currency market? There's complete manipulation and control over our currency here.
Well, that's right. Central banks set monetary policy to try to affect interest rates, to try to help the stable running of an economy. But, I don't see the issue that the distinction between central banks setting monetary policy and other kinds of rules in a free market where the government doesn't intervene in other ways in setting mortgages or setting rents or setting wages. There's a big distinction. It's not all free market or all not free market. And we've seen since the time that central banks have come into being that economies are more stable. And if you look at the gold standard period, there are actually great downturns in that period. In fact, the first Great Depression was not in the 1930s. It was in the gold standard period in the 1800s. And in the 1890s, there was a very deep recession in the United States. And, some of your listeners might know that this gave rise to the William Jennings Bryan and free silver movement. And of course, that's the source of the book, The Wizard of Oz. And the Wizard of Oz is seen as an allegory for the election of 1896.
Professor, what is the likelihood of a return to a gold standard? I mean, just because Judy Shelton, let's pretend her nomination goes through, is in favor of it, doesn't mean that we would head in that direction necessarily. So really, what is the likelihood?
Probably slim to none, because it's really very much sort of a fringe view in economics, and serious monetary economists do not advocate for this. And you saw that with her nomination. A lot of economists from both sides of the aisle said that this is a really bad idea.
Let's put gold aside. And if that's, talk of a gold standard is something of the past, what about the dollar being backed by some sort of digital asset in the future? Like a new Bretton Woods, but with some sort of digital currency?
Again, there are advantages to having a fixed exchange rate, but it's not at all clear that the United States would have an advantage to have a fixed exchange rate. In the Bretton Woods period, when there were fixed exchange rates, it was what's called an asymmetric system. So the United States could set monetary policy as it wished, and then all the other members of the Bretton Woods system had to follow it. That's unlike the gold standard, which some people think was more symmetric, that every country had to follow the price of gold. Other people argue that Britain actually had some latitude at that time. But to tie the hands of the monetary authorities does not seem like necessarily a good idea, unless there are really big advantages by having a stable currency for trade. And that was part of the motivation for the euro area to come up with a stable currency. But trade within Europe is much, much higher than trade between the United States and any other set of countries.
Let's just play out the scenario. If we were to return to a gold standard, what would this do to the price of gold? A lot of people are in favor of it, and gold investors particularly, because they feel that it would really bring up the price of gold to 5,000, 10,000, et cetera. Would that happen should there be a return?
Well, the point of a gold standard is you can't have a rise in the price of gold, right? Because you're supposed to peg it. So the monetary authorities would have to intervene to keep the price of gold stable.
Have you received any feedback directly, Professor, once you put out this essay?
I've gotten a few emails.
We'll leave it at that.
Yeah.
Well, actually, finally, let me ask you, what was the reaction from your students, right? Which I assume are young folks. Do they care about gold, or are they all about, digital currency? You're more plugged in than I am with the young kids. So what was their reaction?
Those who read it found it interesting because it's actually not gold per se, but the idea of fixed exchange rates is something that I talk about in the class that I teach. So this is one variant of fixed exchange rates, a sort of extreme variant in some way. So they were interested in it in that way, or at least to my face, they told me they were interested in it.
Do you ever address currency wars, and do you feel that's the direction we're headed in? Will we see a full-blown on currency war? Do you feel we're in one already? How do you see that?
Well, the idea of currency wars came about with Brazilian finance minister Guido Mantegna in 2010, 2011. I was actually serving as chief economist in the Office of International Affairs at the U.S. Treasury at that time. And it's a very interesting thing because the United States was running an expansionary monetary policy because of the downturn from the Great Recession that started in the fall of 2008. But that caused the dollar to weaken against a number of different currencies, including the Brazilian real. So Mantegna and others were saying, well, this is an aggressive action by the United States. And then to counter that, Bernanke was saying, well, it's really important that we keep our economy growing in the United States because we also import more if our economy is strong. It turns out after that, the real depreciated quite a bit against the dollar because of changes in international conditions. But it is difficult. There are these spillover effects when monetary policy changes in major industrial countries, in the United States, in the Euro area, in Japan. And it's kind of a tricky thing and a political thing to deal with these spillover effects.
Professor, I appreciate your thoughts today. Thank you for taking the time to speak with me.
Thanks. It was a pleasure speaking with you.
And thank you for watching. We'll have much more for you, so be sure to stay tuned to Stansberry Research. In the meantime, you can follow us on all our social media platforms. We're on Twitter, Instagram, Facebook, LinkedIn. We're all there. Thanks for watching. I'm Daniela Cambone.